So good evening, everybody. So the speaker on the today we have Mr. Subaya. He is BTech 1988 batch. BTech PhD la முடிச்சிட்டு he has done a masters in financial management from KJ Somaya Institute of Management, Mumbai University. அதுக்கப்புறமா he is certified financial planning board மும்பைல certification வாங்கியிருக்காங்க. Then he has completed his diploma in commodities market. Then he has completed all the NISM series. There are around 8 series is there. So he has completed national securities series 8 series. So he has done also certification in banking sector. He has got the certification. So last week we have covered the last week link நீங்க அதை பார்த்தீங்கன்னா தெரியும் உங்களுக்கு. We have first சீரீஸ்ல important principles of personal finance investing கவர் பண்ணியிருந்தோம். அதுக்கப்புறமா காம்பவுண்டிங், மெஷரிங் ரிட்டர்ன்ஸ், ரெக்கார்ட் கீப்பிங், டாக்ஸஸ், அதை பற்றி பேசிக்காக கவர் பண்ணியிருந்தோம். இப்போ டுடே we are going to cover second series. Here we will be discussing about fixed income products, government sponsored products, gold and real estate, அப்புறமா direct equity and insurance needs. These are the topics he is going to cover it today. Sanmum sir, வேற ஏதாவது சொல்லணுமா?
Nothing, sir. You have covered it. Now we can hand over to Subaya sir to take over this webinar.
Sure, sir. Thanks a lot.
Yes, thanks.
So thanks, Mohanraj sir, for that wonderful introduction. You had been very nice to us. So let me start my screen. Just please let me know if this is visible. Is it?
Visible, sir, visible.
Okay, great. Fine, sir. So welcome to all the participants. Thanks again for, a nice Saturday evening. You got many other good things to do, but still you have decided to join here. That's very nice of you. Now, this is session 2 of the planned 4 series, event. Now, the second series would have been very interesting had you attended the session 1, either live or probably some of you had attended or seen the YouTube videos. Nevertheless, the recordings are still available there. I would request you, if you had missed the first session, even after completing the second session, you can go just and watch that again. Okay, let's move on now. So session 2, we are starting. We have decided to name this entire series as, the topics on personal finance. We are talking about money, related to money. So this is my opening remarks. So we'll continue to speak about money. Okay, let me do a small, brainstorming. We had covered certain topics in session 1, which Mohanraj sir has mentioned. Now, can somebody, okay, I've already put it out there. We discussed about all these things. We discussed what is savings, what is the difference between savings and investments. Now we talked about, before investing, what are all the major factors one should be clear of. It's not that I have some money, suggest me which investment to do. These are very primary level of, approach to the markets. You should understand certain important things like inflation, which is we call as a taxation without any legislation. We discussed the, the impact of taxation. Then when we move to investing, we talked about how compounding helps you create wealth. Compounding can be on either side of you. If you invest, compounding works for you. If you borrow, the compounding works against you. And it is in your hands whether you continue the compounding chain or break the compounding chain. So we all discussed that. So that leads to the next point, which we talked about, the kind of discipline you need to have, how one should be patient enough, to um, towards investing. Then, like, we took an example of a cricket team where you have, batsmen, bowlers, because they together help the team to win. Similarly, if your investment journey you have to win that journey, you need to have a portfolio of different assets and how you allocate them in what percentage according to your risk profile, which is very, very important. Then we discussed on insurance, and also, like, we do a lot of investments with vigor, with energy, all these things, but we forget to keep nice record of what we do, which can, in the absence of which, can create a lot of troubles for the family as a whole. Then, all these investments have to have their own end goals. Succession planning plays a very important role in that. So we discussed all these things. Now let us move to what we are going to talk about in this session. Here, we'll talk about asset classes in general. Then in this session, we will give importance to the debt side of the investments. The subsequent sessions will take it into equities, and we had planned something more also. So asset class. Now, can somebody define what is an asset class? Let me see if some of you can type in the chat box, or like, what do you mean by an asset? I'll wait for a couple of minutes, maybe 1 minute. So if you can, somebody can type, what do you mean by an asset class? At least some responses. Will it be all right if you can type it in the chat box? I mean, will it be fine if you can? I think I'm seeing some raised hands, but instead of, we can take the one-on-one interaction maybe after the presentation is over. But right now, if somebody can type what exactly is an asset class, what is an asset as a whole? Okay, so Mohdad sir is writing equities, cash, real estate. Fantastic. They're all examples of assets. Now, we will go on defining what is an asset. So, an asset is one which has to give a periodic cash flow. You have something, you put your money somewhere, and that has to give you some periodic cash flows. Or it needs to appreciate in value. Or it can do both. Now, you bought a mobile phone. Does it give any sort of cash flows? Forget periodic or non-periodic. Does it give you any cash flows? No. Or a mobile phone, does it appreciate in value? On the contrary, it actually depreciates in value. So it is not an asset class which is going to create wealth, but of course, it is an asset in the sense it gives you some utility value. Basically, that's an asset which helps you in you doing your whatever work in an efficient way. But here we are not talking about those things. Even a car, right? They all depreciate. So we are talking about something which gives you periodic cash flows, appreciates in value, or it does both. So some examples. Periodic cash flows, you go and put create a fixed deposit, it gives you interest back. Invest in a bond, you get your interest back. Or other than your own house, you bought a house, put it on rent, Again, on a monthly basis, you get some cash flows back. So some examples are that. Now let us go into the next one, which is appreciating in value. You bought gold, it appreciates. You bought land, it appreciates. The time horizon may be very different for each asset class, but they appreciate. Equities. Any good company share price 10 years before, look at the share price today, they would have definitely gone, right? Now, what are the examples of some asset classes which have done both? Simple example is equity. Say 10 years back, what was the price of an equity share? Obviously, that would have gone up. And you also check during those 10 years, did you receive any dividends out of that share? You would have definitely received in all the 10 years if it's a good company. So, asset gives you return periodically, appreciates in value, or it does both. Great. I think it's so good so far. Now, let us bifurcate these assets into different categories. Physical, right? Now, we have one more thing, which is financial. What are the basic differences between these two? The physical one is a tangible one. You can touch and feel it. Whereas in financials, you actually can't touch and feel. If somebody is asking you what is your net worth, you say 5 crores. Person A has got 5 crores in all real estate. He has got a farm, he has got land, he has got everything. And there is somebody who has got all the 5 crores in his mutual funds and demat accounts. Now, somebody who is walking on the road path will obviously be able to recognize the person who has got the farmhouse, lands, all these stuff. That is where actually the people get kickers by investing in physical assets, because they get, kind of recognition that I have, rich assets to, be famous for. So intangible asset investing definitely calls for some sort of maturity, where people may not recognize you that you are that much rich, but you are actually that much rich, right? Now let us understand physical assets. Very simple. You have real estate, you have gold, you have silver, and you also have other commodities. Now, I'm saying all these are physical assets. Are they also available in financial forms? The answer is yes. How? A physical asset, which, an example, real estate, is also available in the form of what we call as REITs, real estate investment trusts. We'll see what are they in the later subsequent slides. Gold and silver, you can buy an ETF, you can buy a mutual fund, or you can buy sovereign gold bonds, which in my view, one of the best investments if somebody decides to invest in gold. Other commodities, obviously you can go to, commodity exchanges, which is multi-commodity exchange or NCDEX. You can go there, buy commodities. If you want to take delivery, you can take delivery, or you can settle before the delivery expiry dates. Okay, now let's move on to financial assets. Here I will digress a bit. Any investor, you talk to anybody, you have surplus cash, where do you want to invest? Immediately start saying either I would like to buy a company share. Or somebody might even say, who's a little more knowledgeable, can say, I would like to invest in, say, company X bond. But have they understood what is an equity and what is a bond? I would like you all to go back a little bit to understand what is an equity, what is a bond. Now I put a word capital structure, right? Again, I need some responses from you. Can somebody tell me what is a capital structure of a company? Obviously, it refers to a company. So, anything, some wrong, right, we shouldn't be bothering about it. Some text. What is a capital structure? Let me wait for 10 seconds. If I don't get any response, then I'll explain myself. Okay, so fine. A capital structure, how do you define it or how do you understand it? A company, any company which runs business needs money, and this money can come in the form of either equity or in the form of debt. This is in the primary building block of understanding investing. You want to invest, but what is happening to that money? You gave money to somebody in the form of equity or in the form of debt. Subsequently, what happens to that part of money, which will determine your success in your investing. Let me take this through an example. Okay, equity is owner's money and debt is very simply borrowed. Let me take this through an example. Somebody called Mr. T. He, along with his group of people, wants to start a restaurant. He says, this restaurant is going to cost me 1 crore, but I and other shareholders have only 50 lakhs. But he needs 1 crore. So what does he do? He has this 50 lakhs. Then he goes to a bank, borrows another 50 lakhs. Now they have 1 crore. They will start the business. They will keep on making teas, buns, and biscuits for 1 year. They do their calculations. They find that on that 50 lakhs, I paid some interest. I also repaid some of the loans. Balance net of all expenses, we have got this much money, which is profit, which belongs to the shareholders. So who makes more money if it is a profitable entity? Obviously, shareholders make hell of a money. Now, does that mean bonds are bad? No, not at all. That depends on your expectation. You are happy with 5%, 6%, but secured stream of cash flows back, the bonds are bad. So this is how a company's capital structure has equity, has debt. Now let us move back to investing. This is what is traded in the entire world of financial markets across the globe. You have nothing else. You have nothing else. Underline, mark my words, nothing else. Whatever you buy and sell, financial instruments, either that will be an equity or that will be a debt. Equity, companies, ownership shares, they are listed on the exchange, you keep on buying them. And the borrowed money, again, in the form of various instruments are getting traded in the markets. So you have equity and debt. So if you come across 50 different types of investments, which sounds French or Japanese to you, please understand this is either an equity or debt, or some financial engineering is done so that they are fused and some derivative product is created. So please understand this. Okay. Now let's move. Having understood what is equity, so far what we have done, keep aside the session 1 where we talked about the basics. In this session, we talked about what is an asset class, what is a physical asset class, which is a tangible one, what is an intangible one, which is a financial asset class. From there we move to the intangibles. We came to know what is equity, what is debt. But before that, we understood what is capital structure. Now we talk about the debt portion of the investing. This session, we are not touching equities. Maybe we'll have some insights into it, but right now let us see how do we invest in debts. Okay, so assume you are the bank which lent money to Mr. T. You will have these following concerns from your side. First of all, safety. Is Mr. T reliable? I given 50 lakhs to him. you can think from the point of view of the bank or anybody who has lent money to Mr. T. It can be a financial institution, it can be neighborhood friend, or it can be somebody, some company who might have given money to Mr. T. Okay. So first, now you are putting yourself into the shoes of a person who has given money. So you have invested in debt. If you have lent money, you have invested in debt. Understand this. So you need safety, liquidity. You were given 50 lakhs of money to Mr. T, or you gave 5 lakhs and remaining all people gave 45 lakhs to Mr. T. Now, whenever you want your money back, will that money be given by Mr. T? There could be condition. Mr. T would have told you, now I'm taking this for 5 years, that is fine. But after 5 years, there should not be any issue. Or is Mr. T making some arrangement so that this 5 lakhs worth of debt instruments, meaning he has borrowed a money, is he making some provision for that to be traded in the market? So that if Mr. T doesn't give money in up to 5 years, you can go to somebody else and say, look, I have this paper. Are you buying this? So you need liquidity. You got safety. Assume you have safety, you have liquidity, but the 5 lakhs which you had given is not growing. What is the big point in taking all these risks? So obviously you need withdrawals. So SLR. Anybody who invests in debt need to understand you have to be taking care of safety per point of view. You should get your liquidity. You should get reasonable returns which are risk adjusted. Now let me get some more technical because we are starting on a base which is very simple. I only if somebody has missed it, I would again request you to see the recordings, and then at least in session 3 and 4 they can be on terms with what we are going to talk about. Okay. So debt, we need SLR, safety, liquidity, returns. Now, all these investments in debt, are they coming out without any risk? There's nothing in the world which doesn't come without any risk. Every money you don't invest everywhere, keep in your pocket, again, that is a risk. There could be a pickpocket waiting for you. You decide to, not take your money, but convert that into gold form. I'm sure you will lose, you will have endless sleepless nights keeping all these gold and taking care of them in the long run. So risk is inseparable from the return. Please understand this. Now, what are the risks in debt investments? First thing, there is something called a default risk. We'll see that in the subsequent slides. So, default risk, the name itself suggests what does it mean. Then the liquidity risk. Remember in the previous, we talked about liquidity. You should have liquidity. Now, that could be a risk of you not having it. Then the remaining two are, at least the third one is what we call as interest rate risk, which is a highly technical one. But I wish all these people who go to the markets understand this before they start investing. Then you have reinvestment risk. Now let me try to decode that. What is default risk, which in other words is also called a credit risk? Now the bank lent the money to Mr. T. Is he going to pay the interest on a regular basis? Two possibilities. Either the teas are not selling. He's making such bad tea that nobody's willing to drink it. In that case, he has put all the money into the business. He's not getting anything back. So obviously, he will not pay you the interest. He will not service the interest. Number two, the tea is phenomenally doing well, but that guy has got not a very nice intention to pay you back, right? But still he pays interest. Now, assume you are getting your annual interest, quarterly interest, everything back, but what about the principal? That's a bigger amount. Will Mr. T not default in paying back all the principal? So these things are very, very critical in investing in debt, right? Now, having understood this, let me put a question. There is a company which is coming out with a debt product. I've taken an example of NCD. NCD means non-convertible debentures, which is again an interest-bearing instrument which pays you interest with a particular tenure. One company is given a 10%. You see advertisement in business line, 10% interest. You go to the next page, another company which is given 8% interest. Now, some responses back in the chat boxes, which company you would prefer, company A or company B? Yeah, please. I think some of you are typing in the Q&A box. I think I'm also seeing chat is disabled. Is that so? Maybe that is one reason where I'm not getting any responses. Mondra sir or Ravi sir, can you check?
Sir, we need to look at Q&A.
Q&A.
I've been checking chat also. Chat is okay, but okay. Fine. I'm looking at Q&A, but some responses. Company A or company B? Company A is giving 10%, company B is giving 8%. There's nothing, nobody is going to take away anything if somebody types B or A or, right or wrong, that doesn't matter. But some interaction will be appreciated. Okay. Depends on, okay, Saravana Kumar Ravichandran is saying depends on company's credit. That is fantastic. Thiru sir is saying company A. Fantastic. The responses itself are good enough. Whether right or wrong, that's a different matter. Now, company A obviously going to 10%. Now, let me give a fresh information to you. Company A has got a credit rating of AAA and company has got a credit rating of BBB. Now, I think the answers would either flip or the conviction with which you gave the answer, I will invest in company A, will become a little tricky now. Company has got a credit rating of AAA, company B has got a credit rating of BBB. Now this leads us to the next unknown thing or area where we need to understand something. Credit rating, right? So the ecosystem has got a mechanism wherein if somebody wants to borrow, somebody wants to lend, the lender will have a support system in the form of credit rating agencies. By law, any company which is raising money is supposed to go to a credit rating agency and get its financials rated. The credit rating agency will give the company a AAA or BBB or D or B, AA, whatever it is. Now, you might wonder, what is that? Right? So, some of the credit rating agencies are, you all know that, ICRA, CRISIL, CAM. Now, let me go back to my previous slide where we discussed the credit rating, AAA and BBB. Now, what do you understand by that? I'm showing you an example. This is a credit, this is given by company CARE, which says, if I give the credit rating as given in the left side column, the right side is the inference of that. Now let me underline only this part. AAA says carry lowest credit risk. Means still it may have some credit risk, but the lowest one will have the AAA. Now let's look at BBB, which we discussed as an example. It will have moderate credit risk, right? Now go back a little more. Go to the last one, CARE D. These ratings are in default and are expected to be in default soon. Now, if there are interest rates given by these companies, obviously AAA rated company will give you less interest and the D-rated company will be probably quoting at 15, 16, 25% interest also. So my point is very limited here. If we see only the interest, I keep getting questions from my clients. Boss, whoa, that particular investment which is giving me 12%, can I invest there? And somebody would say it is only giving 7%, why should I invest there? Then I ask them to flip the coin and see the credit rating. You should look at the credit rating, then you take your own call, because your risk profile is something which either I need to understand, or you take the risk return with complete profiling of what is the possible ways you lose your money in that. So some examples we had seen here. There's another side, of the credit rating. The previous one for long-term borrowings, and this one is for shorter-term borrowings up to 1 year. So they have two different rating scales. Okay, so that was talking about what we call as default risk. Now we talked about 4 different types of risk, right? Default risk, liquidity risk. Now let us move on further. Again, another example I'll take. 2 companies are giving fixed deposits. Here we will assume, say, 2 companies, or you can even say single company giving 2 different tenures. The company is AAA. Let us not get into the previous one. One is giving you 7.5% if you are investing for 2 years. You are creating an FD for 2 years, they are going to give you 7.5%. Now the same company or bank is also have got an option 5-year FD, but the interest are 6.5. Even this is prevalent even now. You look at any bank's interest rate structure, it can vary, but you can still find such things. Now my question is, which one will you choose? Looks to be very simple. So again, fingers on the keyboard. Let me get some examples. Which one you will invest? Okay, so I'm assuming somebody is looking at 7.5% return, and he invests for 2 years. Can I assume that? One second. So I'm assuming people will go for 7.5%. Now, I'm also giving an additional information. The market scenario is such, after 2 years, the interest rates are expected to go down by 2 to 3%. So what will happen now for the person who has invested for 2 years? For 2 years, he will get 7.5%. He gets his money back. Now he wants to reinvest. At that time, he goes and sees the interest rate, they are 2 to 3% lower. Instead of 7.5, he will have now either 4.5 or maybe 5. Whereas the person who was invested for 5 years initially took 1% lower, but then his contract is for 5 years. So for the entire next 5 years, he will continue to receive 7.5, 6.5%, which is far better than a 4.5% of the earlier person who would have chosen company. So this is what we call as reinvestment risk. You invested somewhere, got your money back, you wanted to reinvest, but then you find that interest rates are low. Right. So now let's move on to one of the very, very important risks, which most of the people do not understand before investing in a bond, but let me try my bit to make it a little easier for you. So we all understand a debt fund is a fixed income security which gives interest on a periodic basis, say 8%. So by default, we assume it cannot go into the negative territory. Now I'm giving an example. I've taken government securities. I'm not even talking about private bonds. Somebody invested 1st April in these 4 funds, which are only investing into government securities. Are you able to see minus 2% return. For 3-4 months, they were getting minus negative returns. So it might surprise you. Why should somebody get a minus negative returns if somebody is investing in a bond fund or even in a bond? Negative returns in a bond. How? That's an exclamatory question. Now, this is what we call as interest rate risk. Assume you invested in a particular date in some bonds. After that, the Reserve Bank of India raised the interest rates in the markets. So entire interest rates ecosystem market goes up. It will have a terrible effect on the bonds prevalent at that time. All those bonds will fall in value. So if you hold a bond fund, the NAV will fall down. If you are holding individual bond which is traded, you will find that value going down. It can be otherwise also. If the interest rates are falling down, your NAVs are going to go up, you are going to make some gains. This is what we call as the interest rate risk. This is measured by something called modified duration of the fund, which is beyond the scope of today's presentation. If somebody is interested and can get in touch with me, I'll explain what is modified duration. So this is in the chart format. Now, if interest rates are falling down, the bond prices will go up. And you can flip that also. If the interest rates are going up, the bond prices will come down. Okay. So what are all the normal fixed income instruments which are available? From government side, you can have T-bills, which are less than 1 year, maturity tenure. And beyond 1 year, you have all those named government securities. You have, corporate borrowings. Either it can be in the form of commercial paper, corporate bonds, or debentures. Banks can issue fixed deposit, which you and go can directly go and make it. Certificates of deposits. If you are a bulk investor, you can do it, or through mutual funds, you can invest. So these are all the various fixed income instruments. So before you invest in fixed income products, consider your time horizon, because that will have an impact on both liquidity risk as well as your reinvestment risk. If it is shorter period, not an issue in terms of the interest rate risk, but if you're investing for long, 10 years and all, then the thing which I explained now, the bond interest rates relationship with bond prices will have a very big impact if you're investing for the longer period. So please make sure what is your investment horizon and fix your products accordingly. The credit risk you would like to have, because you need higher coupon rates, then you should be prepared to invest in a BBB or lower kind of papers. You should be good enough to withstand the volatility in the interest rate movements. You were seeing in my previous slide, the government bonds funds were giving negative returns. You should not be selling it off, because at some point it will catch up. Right? You should have that strength to withstand that. Right? Now, what are the three main features of a fixed income instrument? It will have a tenure. Like if you went and created an FD in a bank, the bank manager will say for how many years you are going to put, sir? 5 years. So it will have tenure. It can be perpetual also in some cases. That the tenure is endless. That papers are also perpetual bonds, right? Or some of them can have a call or put option. It is perpetual, but the lender can come and say, I'm closing it, or the buyer or the borrower can go and say, I'm closing it. So the call or put option can be there. It will have a face value. You put a 1 lakh rupee FD, that is what is called as a face value. And the interest rates which you're going to get is called a coupon rate, where that will be printed in the paper, and the maturity value will also be there. Okay, now, since I said government issues debt papers, corporates give it, banks also give it, how does one do? How does in the humongous number of investments, how does one select? If you don't have the time to analyze each and every bond, the best bet is go through a debt mutual fund. They're excellently defined by SEBI. They're very good fit depending on the kind of person you are. There are 16 categories of debt mutual funds. which will make you define what is my liquidity risk, what is my default risk, what is my reinvestment risk, and what is my interest rate risk. So these 16 categories will give some clarity on what kind of risk you'll be taking. We will see them in our subsequent sessions. Today we will not talk about all these 16 types of funds, which we can discuss probably in session 3. We'll have a look at it. Okay, so we also said that we will talk about some of the important government sponsored small savings schemes. I'm not talking about everything. I'm just taking which are some important popular schemes. The Public Provident Fund, Sukanya Samriddhi Scheme, Senior Citizen Savings Schemes, and the rest, your National Savings Certificate, Kisan Vikas Patra, and Post Office, FD and RD, right? Here I'll pick up 2. Now, before that, some critical, very important points about this. The PPF and Sukanya Samriddhi are falling in EEE category, which is exempt. Meaning the money you put in is exempt from taxes. You in fact get a deduction in your taxes. The interest you are accruing is also exempt. Finally, when you withdraw, that is also exempt from taxes. So they're very beautiful in terms of not getting taxed at all. All the other products, the interest income is taxed. Senior Citizen Savings Scheme, one can invest up to 30 lakhs. Interests are very attractive, 8.2%. Now that interest is payable quarterly, which will work out to 8.46% per annum. Earlier, the limit was 15 lakhs. Now it has moved to 30 lakhs. One more Sukanya Samriddhi Yojana scheme. This is specifically meant for girl child. Can be opened for any girl child who is yet to attain 10 years of age. You can deposit 1.5 lakhs per year, which qualifies for Section 80C. This falls under EEE, we have seen. How do you close this? After age 21, or if the girl is getting married after age 18 years, can be closed. Premature closure possible, but at certain conditions. Interest, what you have is 8%, slightly lower than the senior citizen savings schemes. We are moving to now gold. Gold, again, you have all the glitter in the physical form, but no glitter in the digital form. Now, digital form doesn't have glitter, but it gives you money. Physical form full of glitter, but the glitter is very costly. You know how much making charges and all these things if you buy something in physical form. So bars, coins, and jewelries, they all come into the physical mode. Digital forms, sovereign gold funds, and the exchange traded funds and the mutual funds. Now, I'll only pick up the sovereign gold bonds. They keep coming. The issues are regularly given by the government. 8 years you need to hold them. If you hold them for 8 years, there will be no capital gains. The beauty of this particular product is no other product gives you interest, but this particular product gives you 2.5% annum interest. Now, we talked about liquidity risk, right? How is it here? Liquidity is provided through stock exchanges because these bonds are getting listed there, but liquidity can be very less. But RBI provides after 5 years, it opens an exit window. If somebody moves through that exit window, the capital gain exemption, which is given for 8 years, will not be there. So he has to pay the capital gains. I'll give an example. Here the prices, I give a disclaimer here, the prices are taken from net. I've not checked the correctness for the data, but nevertheless, it serves our purpose. Because you might have a doubt, if I invest in SGB, how do I get my money back, in what form? You're not investing in gold, you are investing in only paper. So November 2017, the issue series 7, whatever it is, was at 2934. It is directly correlated with the gold price. Now, after 5 years, RBI has opened the window and they have fixed the repurchase price at 6047. Now, somebody has invested at 2934. After 5 years, he is getting 604. This is as simple as this. You pay through your bank account, RBI gives you back to your bank. So you have gold ETFs also. ETFs are, exchange traded funds which are traded in the stock market. You can on a daily basis buy and sell gold, or you invest in a mutual fund which you buy from the mutual fund, and you can also sell back to the mutual fund. Disadvantages of physical form of gold we've already seen. Very high transaction costs. You pay GST on that. Then after buying, the headache actually starts. You need to find a place to keep it, safe. It can get misplaced or it can get stolen. And last, we don't even need to, try to understand the impact of the wastage and the making charges. So my conclusion on this is, unless and otherwise you have real application of physical jewelry, till that point of time, please invest in number one, SGB, number two, either a mutual fund or an exchange traded fund. Fine. Let's move to the real estate side of the financial forms. We discussed you can buy and sell real estate in financial forms. One is REITs, real estate investment trusts. The other one, not many people know this, INVESTs, infrastructure investment trusts. As the name suggests, real estate invests in buildings. REITs invest in buildings which are mainly for commercial use, and INVESTs, they invest in infrastructure projects which can be highways, which can be, the power grid infrastructure or an airport, or all these stuff will come under the INVEST format. So they are like mutual funds. Anybody who invests there, they are allotted units, and these are listed in the stock exchanges. Regulation is a very big regulation for REITs. SEBI has got a separate regulation for REITs. I'm picking only two important points here. 80% of the money collected by the REIT should be invested in income producing assets. Not that I'm creating this property, take money from the people and start building a property. No, you can do that, but only up to 20% of the money invested. So that is one firewall. Now, another one is at least 90% of the distributable income should be paid back to unit holders on a biannual basis. Like they collect rent, they sell off something. So whatever they have other than expenses, deduct all the expenses, they have to, at least 90% of them should be distributed back to the unit holders. So that is good cash flow mechanism built in there. Now, in what all formats you can get your money back from the REITs and InvITs? Either it can be in the form of dividends, or they can give you back interest, or some of them in some mechanism, there is something called return of capital. That's a complex structure, how it happens, but you can receive money in all the three forms. For example, you can go into any annual report of a REIT, say Brookfields or Embassy Parks. Just look at them. In some page, they would have mentioned the P&L account. After that, how much money they're given to unit holders and under what breakup. So under dividends, how much? Under interest, how much? Under return of capital, how much? And all the three will have different tax aspects, which is again beyond the scope of this presentation. We can take it if somebody is interested. Okay, now let's get into one of the, what you call, something which attracts people very easily, but fails to deliver that easily to the people, which is investing in stocks. Because all these, the YouTubes, the channels, everybody will give you a hype that, it's so simple. You hit the button, buy something, hit the button, sell something, you made a profit. Not so. Even now, only 4 to 5% of the Indian population invests in equity markets. So that's too small a number. That doesn't even deserve such kind of discussions which are taking place in the households. And out of that 4%, most of them are traders. And out of that traders, 90% of the traders lose money. Yesterday, I was opening my Demat account trading platform. I don't trade, but still the platform is meant for that. First thing I had was a disclaimer. It is showing, it is wanting me to accept that, saying 90% of people lose money in trading. And even somebody made a profit. If you look at the expense side, at least 50% of them for most of the cases is given by way of trading costs. Agree. Then I had to tick the button agree. This is something new they had built up. So they are businesses which are listed in the stock exchange, not some app which gives you a kind of kick that by doing this you will definitely get some money. No, please. Either understand now itself, or after 10, 15, 20, 25 years of playing all these things and losing all the money, you will understand that. Right? So try to focus your learnings on, if you're buying something, you're buying businesses on the stock exchanges, right? Now, these businesses, say for example, some business like Britannia, we still remember we used to eat Britannia when we were 5-year-old. We are still eating Britannia, except the fact that at that time they would have got 5 variants, now they have 500 variants, right? And imagine the person who is a shareholder in that company in the last 50, instead of eating biscuits, you could have owned the shares of Britannia, you would be sitting on a gold mine or Britannia mine. I would rather even not compare gold, Britannia mine, right? So they give superlative returns, but they take a cost of it. They want you to wait for decades. Right? So direct stock investing is made to look very easy. May take it from me. It's very, very difficult if you don't have the basic tenets of patience and discipline. So again, I'm continuing with the same. Like any other profession, direct stock investing needs full-time attention on a daily basis. You need to study them, annual reports, balance sheets, quarterly reports, research reports, all these things. Not on a standalone basis, but on a continuous. If you're going to hold a company for 5 years, you need to have at least 5 into 5, 4 quarterly reports, 1 annual report. 5 into 5, 25, that is for given. Other than that, you need to, keep watching what's happening in the company. These are all some of the metrics. Like if you buy a company, you should know what is the price to earnings ratio. We are not going to discuss all these things. I'm just saying all these things are there, highly technical terms, but still people will jump by seeing some message from some SMS saying that buy this, sell this, stop losses. They just do that. Price to book, you need to understand. Price to earnings growth, you need to understand. Price to sales, price to cash flows, earnings per share, return on equity, return on capital employed, and these are all only a small portion. You need to know much more. Okay, so I'm just digressing you with an example, like how do you decide to buy an equity share? The case of, I call it a case of apple farms. I'm putting some questions. You need not answer this, but I'll take one by one. There are 2 apple farms with 1,000 apple trees. Please understand, you are trying to buy an equity share. How do you decide? I'm trying to explain this through an example of 2 apple trees, apple farms. One has got 1,000 apple trees. The other one has also got 1,000 apple trees. Both are up for sale. Now the owners have put the price. One is saying 1.5 crores A, and the other one is saying B, which is 1 crore. Now which one you are going to buy? Obviously, you will see 1,000 apple trees, 1 crore. Why should I pay 1.5 crores? I'll buy one. This is what 98% of the people will do when they approach a share market. Look at the price. 10 rupees I'll buy, 1,000 rupees. Now let me give some information on this. Obviously, like I said, in the absence of any other info, you will go with the lower price. You will go and buy Form B. Now somebody is coming to you and say, boss, Form A, actually they produce apple which fetches twice the price of Form B. If an apple from Form B gives you 50 rupees per apple, Form A apples, they are giving you 100 rupees. Now you got stuck like me. You immediately flip your decision. No, no, no. Let me buy Form A. Then somebody comes out with another, info. Form B produces twice the number of apples. Trees are only 1,000, but each tree produces more number of apples than the trees of Form A. You flip again, right? Now from A, B, you are moving now. Now you decided that no, you did some calculation, how many apples they produce, what is the realization for this apple, all these stuff. Then you decide to visit that place, you find that Form B is not easily accessible. Form A can have their gate and immediately truck loaded, apples move out immediately to the markets. Form B do not have it, so they have to, do roundabout. There are a lot of problems, particular time only the way the roads will open. So they incur a lot of cost in that. Now you move again back to flip A, Form A. Now the bouncer, the owner of Form B has got some farming technique. He is able to make trees produce 15% more apples year on year. Today it is making 1,000 apples. Next year it will make 1,150 apples. Right? So for simple apple farm, you got all this info, and there are so much of other info which you may not know till you make a decision to buy. When you have complexity in purchasing a simple apple farm, imagine the kind of homework one needs to do before buying businesses. That means stocks or shares. So they are not simple. They are not easy. They look very easy, and that is why people, it's very deceptive. Okay, so let's move on to insurance. You touch your, you wanted to buy some insurance, hit the button in your laptop, it will pour the number of insurance products. So many companies, so many products. Never ever get yourself immersed into it. Please decide, I'll separate insurance from investments. Let me take care of protection in the form of pure insurance, which is called as a term insurance. With the term insurance, let me have some riders. Riders means conditional assurance. If something happens in this form, it will compensate this way. Take that and focus on, that's on the life insurance part. Then focus on getting a health cover for one and the family. So only two things. Take a life insurance in the form of term insurance, cover your family with health insurance. Term insurance, why? They give very high sum assured. The moment you pay the first premium, the estate is created for the family. But with very low premium. You can just go back in the night and check what is the, put your age, say 1 crore term insurance you need, what is the premium? Now go to some other product, enter the money back, all these 1 crore sum assured, what is the premium? You will lose your sleep, right? Please understand the premium you pay for term insurance, do not come back, let it not come back. You don't need it. Something like a motor insurance or car insurance. Do you need your money? The money paid for car insurance, do you get it back? You don't get it back. But you're happy that there is a promise to cover the expenses. Health insurance, if you have a cover from your company, still buy one, because the moment you stop working for that company, the coverage stops. People, most of them do not understand, or they think, okay, let me move out. We'll sit freely and then discuss about buying something else. Don't do that, because there could be some days where you may not be covered. When you buy a health insurance, think of having a top up or super top up also. Somebody is interested in what is a top up, what is a super top up, they can get in touch with me. We can have a discussion on that. Or maybe if but someday it is allowed that we can do a program on that, we can do a detailed drill down. Okay, the riders we talked about, some of the riders I'm talking, there could be many other riders, personal accident rider, meaning if this condition happens, the compensation would be higher. A critical illness rider, other than the regular policy, if a critical illness strikes, then some amount is given. Premium waiver rider, it's self-explanatory. And some of the riders can be taken as a standalone policies also. So I think I will close here. So we covered, just to give me 1 minute, we talked about what is an asset. It has to give you something back. And we talked about physical, financial, tangible, intangible. Then we discussed physical, but more we concentrated on the financial forms of those physical, like gold, SGB, real estate, REITs. Then we moved to discussing a capital structure of a company, equity and debt. Equities, we understood both of them, but we decided to discuss only debt here. The debt, we discussed why we need a debt, what are the things which look for safety, liquidity, returns, and what are the various risks, say for example, a default risk and a reinvestment risk, the credit ratings, all these things we saw. Then we moved to discuss REITs and InvITs. We also talked about gold. We talked about direct equity, which is not an easy game, but people think it's very easy. I just showed what is the basic quality of becoming direct equity investor. You need to spend almost full time in doing it. Then we talked about insurance. So this is what we had covered in this. Then I think the announcement will come soon as to what we are going to cover in session 3. So thank you for your patient hearing. So I'm closing it here.
Okay.
Let me
Thank you. Thank you, Subaya sir. That was a wonderful presentation. I think our attendees have gained a lot of information related to different areas of financial information. Let me summarize the today's presentation also. Sir has covered the different asset class, both physical and financial assets, capital structure, direct and equity and debt, and how to invest in a debt, what are the risks, returns, profiles associated. And Sir has covered the credit rating, the different types of credit rating, what it means all about, and the different FD returns available, and different fixed income instruments available in the government side, government sponsored small savings scheme like Suganya Samriddhi scheme, all these things. Subaya sir also touched upon the rates and InvITs also, and direct equity, what are the different points to be looked at before investing it, how to buy a business, what are the different parameters to be looked at before buying it, the how the need to understand the complexity of buying the equity. All these things he has covered in a very detailed way. And finally he touched upon the insurance needs also, how you need to differentiate with respect to the instruments on the insurance part. Thank you very much, Subaya sir. It was a wonderful presentation. I think a lot of takeaways from this presentation. Hope our alumni members and their family members and friends have benefited from this presentation. And we are a lot more to cover in the upcoming presentation also. There are 3 and 4 session webinar also is under planning stage. We will let you know the exact date and timing in the coming weeks. Thanks again, Subaya sir, for this wonderful presentation. I request Navani sir, to give the closing remarks.
Shanmugam sir, you beautifully summed it up. I'm very happy. I'm almost feeling as if I've learned something.
Okay.
Great.
Thank you, sir.
Shanmugam,
And yes, sir.
Shanmugam, you summed it up very well.
Okay.
It is unfortunately we have only very few participation, but the people who watch on YouTube subsequently at their convenience. I request all the people who watch these videos to post their comments When if you are doing live, you can ask your questions, your comments. We could try and attend then and there. Or others who are watching on YouTube, please post your comments, whether you like it or don't like it, whether certain things you are not able to understand, so that we can plan further to reach out to you, tell you if you have not understood what it is. Our aim is to make all of the viewers knowledgeable with the primary knowledge of financial markets and what are the options and what they can get, how they can generate their wealth to higher levels and live comfortably. So with that being the motive, unless you ask questions, some of you, most of us are engineers, some of us may not be knowing what is a mutual fund, what is a share, even fundamentals. So unless you ask questions, we will not be able to address those things. Because if you're going into those levels, will be very difficult. We assume that you have some basic knowledge. From there, we are starting. So we welcome all types of questions, whether big or small. Post it in your comments section in YouTube, which we will reply then and there, or we will take it up in the subsequent sessions. That's all I wanted to contribute. Thank
Absolutely.
you.
Yeah. If any questions, you can write to subaya@adepassets.com also. Any queries, investment related questions, all these things, it can be mailed to subaya@adepassets.com.
They could post their comments in the YouTube comment box.
Okay.
From there, we'll take it.
Sure.
We'll be viewing those things periodically. We will attend to those things.
Sure.
So, from the participants, anything in question answer now?
No, sir. I'm just looking at, there are any specific questions. There are no specific questions.
Then we can close it.
Yeah.
Next session, we will be having it soon. That will be a session 3. Whatever we have covered in session 1 and 2, the next session will be a very important session, which is basically covering the risk and returns and the taxation of mutual fund. Whatever we learned in session 1 and 2, the important aspect of tax will be discussed in the next session, and the portfolio management services will be discussed in the next session. The date will be announced soon after discussing with the committee members.
Absolutely. Yes. Thank you all for participation. Thank you, Subaya sir. Once again, thanks.
My pleasure, sir. Thanks for
all right.
Here.
Thank you, sir.
Thanks.
Bye. Thank you all.